Day trading is speculation in securities, specifically buying and selling financial instruments within the same trading day. Strictly, day trading is trading only within a day, such that all positions are closed before the market closes for the trading day. Many traders may not be so strict or may have day trading as one component of an overall strategy. Traders who participate in day trading are called day traders. Traders who trade in this capacity with the motive of profit are therefore speculators. The methods of quick trading contrast with the long-term trades underlying buy and hold and value investing strategies. Some of the more commonly day-traded financial instruments are stocks, options, currencies, and a host of futures contracts such as equity index futures, interest rate futures, currency futures and commodity futures. Day trading was once an activity that was exclusive to financial firms and professional speculators. Many day traders are bank or investment firm employees working as specialists in equity investment and fund management. However, with the advent of electronic trading and margin trading, day trading is available to private individuals. Some day traders use an intraday technique known as scalping that usually has the trader holding a position for a few minutes or even seconds. Most day traders exit positions before the market closes to avoid unmanageable risks, negative price gaps between one day's close and the next day's price at the open. Other traders believe they should let the profits run, so it is acceptable to stay with a position after the market closes. Day traders sometimes borrow money to trade. This is called margin trading. Since margin interests are typically only charged on overnight balances, the trader may pay no fees for the margin benefit, though still running the risk of a margin call. The margin interest rate is usually based on the broker's call. Because of the nature of financial leverage and the rapid returns that are possible, day trading results can range from extremely profitable to extremely unprofitable, and high-risk profile traders can generate either huge percentage returns or huge percentage losses. Because of the high profits and losses that day trading makes possible, these traders are sometimes portrayed as bandits or gamblers by other investors. Day trading is risky, especially if any of the following is present while trading. Trading a loser's game/system rather than a game that's at least winnable. To survive. Incompetent money management, that is executing trades poorly. The common use of buying on margin using borrowed funds amplifies gains and losses, such that substantial losses or gains can occur in a very short period of time. In addition, brokers usually allow bigger margins for day traders. In the USA, for example, while the overnight margins required to hold a stock position are normally 50% of the stock's value, many brokers allow pattern day trader accounts to use levels as low as 25% for intraday purchases. This means a day trader with a legal minimum $25,000 in his or her account can buy $100,000 4x leverage worth of stock during the day, as long as half of those positions are exited before the market close. Because of the high risk of margin use, and of other day trading practices, a day trader will often have to exit a losing position very quickly, in order to prevent a greater, unacceptable loss, or even a disastrous loss, much larger than his or her original investment, or even larger than his or her total assets. The following are several basic strategies by which day traders attempt to make profits. Besides these, some day traders also use contrarian, reverse strategies, more commonly seen in algorithmic trading, to trade specifically against irrational behavior from day traders using these approaches. It is important for a trader to remain flexible and adjust their techniques to match changing market conditions. Some of these approaches require shorting stocks instead of buying them. The trader borrows stock from his broker and sells the borrowed stock, hoping that the price will fall and he will be able to purchase the shares at a lower price. There are several technical problems with short sales. The broker may not have shares to lend in a specific issue. The broker can call for the return of its shares at any time, and some restrictions are imposed in America by the U.S. Securities and Exchange Commission on. Some of these restrictions, in particular the optic rule, don't apply to trades of stocks that are actually shares of an exchange-traded fund (ETF). 1. Trend following, a strategy used in all trading time frames, assumes that financial instruments which have been rising steadily will continue to rise, and vice versa with falling. The trend follower buys an instrument which has been rising, or short sells a falling one, in the expectation that the trend will continue. 2. Contrarian investing is a market timing strategy used in all trading timeframes. It assumes that financial instruments which have been rising steadily will reverse and start to fall, and vice versa. The contrarian trader buys an instrument which has been falling, or short sells a rising one, in the expectation that the trend will change. 3. Range trading, or range-bound trading, is the trading style in which stocks are watched that have either been rising off a support price or falling off a resistance price. That is, every time the stock hits a high, it falls back to the low, and vice versa. Such a stock is said to be trading in a range, which is the opposite of trending. The range trader therefore buys a stock at or near the low price, and sells and possibly short sells at the high. A related approach to range trading is looking for moves outside of an established range, called a breakout, price moves up, or a breakdown, price moves down, and assume that once the range has been broken prices will continue in that direction for some time. 4. Scalping was originally referred to as spread trading. Scalping is a trading style where small price gaps created by the bid-ask spread are exploited by the speculator. It normally involves establishing and liquidating a position quickly, usually within minutes or even seconds. Scalping highly liquid instruments for off-the-floor day traders involves taking quick profits while minimizing risk, loss exposure. It applies technical analysis concepts such as over/underbought, support and resistance zones as well as trendline, trading channel to enter the market at key points and take quick profits from small moves. The basic idea of scalping is to exploit the inefficiency of the market when volatility increases and the trading range expands. Scalpers also use the fade technique. When stock values suddenly rise, they short sell securities that seem overvalued. 5. Rebate trading is an equity trading style that uses equity rebates as a primary source of profit and revenue. Most ECNs charge commissions to customers who want to have their orders filled immediately at the best prices available, but the ECNs pay commissions to buyers or sellers who add liquidity by placing limit orders that create market making in a security. Rebate traders seek to make money from these rebates and will usually maximize their returns by trading low-priced, high-volume stocks. This enables them to trade more shares and contribute more liquidity with a set amount of capital, while limiting the risk that they will not be able to exit a position in the stock. 6. The basic strategy of news playing is to buy a stock which has just announced good news, or short sell on bad news. Such events provide enormous volatility in a stock and therefore the greatest chance for quick profits or losses. Determining whether news is good or bad must be determined by the price action of the stock, because the market reaction may not match the tone of the news itself. This is because rumors or estimates of the event, like those issued by market and industry analysts, will already have been circulated before the official release, causing prices to move in anticipation. The price movement caused by the official news will therefore be determined by how good the news is relative to the market's expectations, not how good it is in absolute terms. 7. Keeping things simple can also be an effective methodology when it comes to trading. There are groups of traders known as price action traders who are a form of technical traders that rely on technical analysis but do not rely on conventional indicators to point them in the direction of a trade or not. These traders rely on a combination of price movement, chart patterns, volume, and other raw market data to gauge whether or not they should take a trade. This is seen as a simplistic and minimalist approach to trading, but is not by any means easier than any other trading methodology. It requires a sound background in understanding how markets work and the core principles within the market. But the good thing about this type of methodology is it will work in virtually any market that exists: stocks, foreign exchange, futures, gold, oil, etc. 8. An estimated one-third of stock trades in 2005 in United States were generated by automatic algorithms, or high-frequency trading. The increased use of algorithms and quantitative techniques has led to more competition and smaller profits.